us. Well, let's get in Gautam Sinha Roy, Executive Vice President and Fund Manager at ICICI Prudential Life Insurance, who joins us on the show. Hi, Gautam. Good afternoon and good to see you after a while. What's your view currently on the markets? There's plenty of interest. I mean, we have been thumping the table that this decade belongs to India, the next few decades as well. But how are you feeling at current reckoning? Valuations not very, very cheap. Some of those mid and small caps, maybe they're overheated. Your view on the markets, as well as how are you positioning yourself now between large and mid caps?
Good afternoon. I think I would like to agree with you that given the rally in mid and small caps, probably if you had to allocate incremental money today in India, you'd of course be towards large caps. But the long-term story of India remains very strong. Valuations have run up, but they're not very demanding at around 19, 20 times forward. They're not really very demanding. So would you be actively putting money into India? Definitely yes. Would you try to find new stock ideas? Definitely yes. But between mid and small caps and large caps, I think that large caps are offering much more value on the table today, especially given the recent bout of selling that we have seen in some of the large cap counters. And within large caps also, when you see some of the large sectors, be it the banking, financial services and insurance, be it IT, be it some of the oil and gas sectors, I think valuations are definitely supportive in many of these stocks. And the earnings growth profile of large caps is also fairly decent. If you take out some of the volatility related factors, probably a mid-teens kind of earnings growth India is able to deliver today. And within that also, what we are seeing with a lot of interest is that the earnings momentum is improving in the sense that there are more earnings beats than misses, right? So earnings expectations are moving up. So we are in a very positive.
Okay, got that. Gautam, hi, afternoon, Prashant here. Now, this is more a question for somebody who does personal finance, but I'm going to ask you, and this is a real question, by the way. Somebody asked me, and I said, well, I'll put it to, somebody who manages money, and I'll get you the answer. So if somebody's got a home loan, right, and they're paying, 9.5% because rates have gone up quite a bit, they're kind of thinking between whether to take money out of stocks, and stocks have done well, to repay a significant part of their home loan. The opportunity, the cost is 9.5%. I mean, if you can beat 9.5% in a very substantial way, I don't know. I mean, how do you think about that question? It's a real question. I don't know. I mean, I got that from one person, but I'm sure many are in that kind of a predicament, or they're thinking about it like that. Because should you book some gains and sort of, repay liabilities to a large extent? Your thoughts?
Yeah, especially on that's a good question, Prashant, by the way. And, especially on the mortgage liabilities, there could be some tax breaks which have to be taken into consideration. But keeping it simple, if you are asking me whether there is a double-digit return on the table from equities over the long term, that's essentially your question, right? Simply speaking, I think definitely yes. So this is not a market where you're looking for, sustained single-digit compounding only for a long period of time. I think double-digit return in markets is definitely on the table. So hence the answer for me at least would be stay invested in equities. Yeah, incremental investing, how aggressive you are on the equity side, that's a separate question, and that was not your question. But whether one should remain invested in equities and not book profits and fund liabilities, I think one should remain invested in equities, definitely.
But double digit is 10% and 20% also. So would we be closer to... that will also make a lot of difference, right? I mean, if you're making 11, 12%, and you're paying interest rate of 9.5%, which perhaps can go up even, what's the trade-off?
So thankfully, you made my question simpler earlier by keeping the hurdle a single-digit number. But yeah, as you're right, double-digit can mean anything. But yeah, I would not be very, very aggressive on that front. I would say early teens is very.
Prashant, what would you do?
I'd pay off the loan. I'd pay off the loan.
I would ask.
You can't put a price on sleeping well, Just at least a substantial portion of it.
I would ask Gautam the next question that will help me arrive at that same answer, which is Gautam this. Now, the pockets where a lot of money had to be made, I think those pockets have run up a lot, right? And those ideas are well known, well discovered. We're talking defense, we're talking capex. And that's all happened. There are other areas, like IT, where the problems are only too well known. And I don't know if too many people are willing to stick their neck out and go out and buy more now when the tide is low. So the question is, incrementally, if you are going to chase at least those, double-digit returns, let's say mid-teen returns, at least 14, 15%, then realistically speaking, where are the opportunities?
Yeah, Shobhi. So the opportunities are definitely in banking, in IT too, especially if you have a 3-year horizon, given the valuations have corrected there, and multitude of other mid and small cap sector where you will at least get the earnings compounding. Valuations have run up, but the earnings compounding from here in many of these sectors should continue to be strong. And these are sectors which have evolved over the last 3 years into very profitable sectors. I have given examples of hospitals and hotels earlier. I'd give the same. We're discussing electronic manufacturing companies a bit earlier, the entire Made in India theme, that is there. Of course, some pockets are overheated. I would think that the capital goods companies, some of the defense names, they have run up quite a bit. They could let off steam for a while. But, we'll have to distinguish between a tactical position and a more fundamental long-term position here. Because, it's very easy to get caught in that tactical thing and sell off stocks. And what's the guarantee that you will be able to buy the same stocks again at a lower price? And they could be multi-year compounding stories. And that's how we are seeing many of these themes today. So that's why my reckoning is that as long as you are getting early teens compounding from markets over a 3-year horizon, this is a kind of market where essentially you don't need to do much, honestly. So, many people are very activity oriented, not a great advice for them to hear. But honestly, this is not a market where you necessarily need to do a lot. This is a market where you just sit tight, according to me.
Nigel, I'll revise my answer. It's an important question. I was thinking about it. I was not expecting to be asked the question.
Yeah.
I think if the question is what would I do if
Yes.
I had a large loan and I had investments which have done well, would I liquidate some of the investments and pay off the loan? I'd pay off 40-50%.
50-50.
And let some run as well and not kind of, if it is 1:1, let some run. And actually, the loan product is also a fantastic product, right?
Yeah.
It allows you leverage at a very low cost if you think about it over a long period of time, like 15, 20 years.
Right.
So, and there are tax advantages, etc., associated with it. So repay 30, 40, whatever, half of it, and let the rest run. I just want to make that
So benefit of peaceful
hypothetical,
sleep
but yes.
and the power of compounding all rolled in one.
I'll tell you what I'm personally doing. Actually, I'm paying off the loan in a smaller quantum, but I'm keeping the SIPs going.
Yeah,
so
absolutely.
that's the way I'm planning, since we are all sharing.
Prudent planners here, both of my co-hosts. Okay.
Gautam, we want to hear more out of you. We're just chipping in with our bit.
Gautam is wondering why this is a personal finance show.
This was a fun conversation.
But no,
Can I add to it? There's a lot of option value to that loan product, what Prashant was hinting at, to have that. And I personally experienced this, honestly, and missed it sometimes, honestly, because I prepaid one of my mortgages early. But there's a lot of option value to having, that kind of liquidity at your hand at an attractive price. This comes in really handy when, you want to get more aggressive on market. So, yeah, not necessarily carrying on that discussion, but I totally agree with you that you should not completely pay off your loan for sure.
Okay, so Gautam, we will then leave it on that note for today. Thank you very much for joining
Interesting chat, right?
Interesting chat, slightly different chat, but very, very interesting. You have a good day, and we look forward to connecting again soon. Quick break on that note. We will come back, and as always, we'll get you a check on what dealing rooms have been saying, all the chatter with Nimesh, and then, of course, a couple of other trading ideas before the day winds down.